Good morning, everyone. I would like to welcome you to today's online presentation, Siegel Rogers Casey's Investment Outlook Q1 Update, Spring Forever. Now I would like to introduce you to our speakers. We have Alan Kozan, Senior Vice President, Head of Alpha Investment Research, and John Ross, Senior Vice President and Head of Beta Research. With that, I will turn things over to John to begin today's presentation.
Great. Thank you, Kate. Good morning, everyone, and thanks to all for taking time out of your busy schedules to join us today. For those of you who have joined us for other webinars, our format will be the same. I'll take a few minutes to walk you through some of our observations around recent macroeconomic developments and trends, both domestically and internationally. I'll then turn the mic over to Alan to comment on what we believe are relevant investment implications at the broad asset class level and perhaps investment strategy level. And then lastly, we'll answer as many questions as time permits. As we move through the presentation here, the gray shaded areas on the slides depict changes or additional information relative to our last report, and they will serve as a backdrop for both my comments and Alan's comments today. So if we could move on, make sure we show the disclaimer, give that a couple, 3 seconds so everyone can read it, and moving right ahead. Okay, so with that, what have the markets given us year to date? First, a little bit of what we expected in the form of slow growth, both domestically and internationally, albeit kind of somewhat disappointing Q1 growth across the U.S., Europe, and China, with Q2 growth prospects picking up a bit. Second, perhaps a bit of what we didn't expect in the form of a rally in sovereign debt yields, with the U.S. 10-year Treasury yield dropping about 40 basis points or so far this year, and as an example, the German bund yield falling about 60 basis points. I guess embedded in those results is the continuation of kind of predicted volatility we've become accustomed to in the markets over recent history. So I guess you could say that we're 2 for 3 in that group. Looking in the U.S., first, slow growth has been an ongoing theme here, even though kind of sideline cash, if you will, has supported inflows into the markets and therefore valuations to some extent. Early on in the year, inclement weather, a drop in exports, and negative inventory effects reined in growth for the first quarter. A few factors might help to mitigate some of the headwinds we've been facing here over the past several months, but many of the factors we would still kind of remain cautiously optimistic on, I guess. So let's kind of walk through those. First, government spending for the first time in several years is expected to contribute to growth. And less uncertainty over fiscal policy should also boost the private sector, or at least until the debt limit needs to be raised again in 2015. In housing, we see kind of competing forces. So in the past 6 months, we've had lower housing formation, certainly tighter lending standards, higher mortgage rates to a certain extent, and rising home prices. More recently, some of those trends have reversed. Banks are loosening lending standards a bit. Mortgage rates have stabilized, and there's been a small, if you will, kind of deceleration of home prices, suggesting improved affordability. So all in, housing is an area to watch closely over the coming months, and we think it's a key consideration for the short to intermediate term economic growth. I guess there's no real news there. That's been a primary driver for the past couple of years. Directly related is consumer confidence. Balance sheets have improved as home values have appreciated, along with stock prices to a certain extent. However, spending we would still kind of characterize it as cautiously higher. Improved balance sheets haven't fully translated to greater spending, but we're kind of moving in the right direction. Consumer confidence may trend up throughout the year, supported by improving financial market conditions and kind of the continued improvement in household net worth. But the long-term effects of new healthcare rules and the related costs on real consumer spending are going to need to be watched pretty closely.